Our next speaker has really created a company that is, am I on? Yes, okay, has created a company that is one of the leading lenders on the planet today. He only started it in 2010 and already they have crossed $100 billion in total loans issued. Now, primarily he has been focused on real estate. He's now bringing his attention over to consumer loans. So please join me in welcoming the founder and CEO of loanDepot, Anthony Hsieh.
Good morning. How's everybody doing today? Well, it's interesting, as I think this is my third year now at LendIt, and we're talking about all the technology advancements over just the last 3 years. But just a little bit of background about myself, and maybe you get a chuckle at my real biological age, and this is going to date me a bit. But I've been in consumer lending now for 30 plus years. And it's really interesting, and where it makes me pretty unique to be up here and talk to you today. I actually took my first loan application as a loan officer in the mid-'80s with a typewriter. That just tells you how far the world has changed in just my generation. Now let's talk a little bit about my company, loanDepot. Here's just some of the basic math, just to give you some background of where we are in the marketplace, and more importantly, what we aspire to be, as I really believe that we're still very early, possibly bottom of the first or top of the second inning. So like Peter mentioned, we're 7 years old, and we just completed $100 billion of fundings since inception. The bars there show our quarterly volume or fundings quarter over quarter. As far as scale and marketing, this year we're forecasted to spend over $230 million, and we're currently driving more than 500,000 fresh consumer leads each and every month. We have averaged over 70% year-over-year growth for the last 7 years, and we're currently the second largest non-bank consumer lender in the marketplace. All that sounds fairly impressive, but the opposite way to look at this is also the fact, being number two, we're actually less than 2% market share. So very, very early. To understand a little bit about what's happening in this cycle, I think we have to look beyond just technology. Certainly, that is one of the primary environmental change that is fueling some of the consolidation and some of the excitement, certainly around this conference. But let's look at the debt outstanding in the country for the last few years, particularly post-crisis. You can see very clearly that the market has deleveraged. Consumers, as of 2012, decreased its debt load from the peak of $12.7 trillion down to $11.3. And as consumers started to feel better about the economy, the job security, here comes the American way. We're starting to lever up. Last year, the math is back to almost 2008 levels. That looks great, but there's quite a bit of changes in this cycle that I've not seen in the 30 years that I've been in this industry. Now let's take a look at it. The blue line there is fairly significant. What that represents is the overall percentage of home mortgages relative to the entire consumer debt load. Although the country and consumers is borrowing again, the overall percentage of mortgages and home equity is decreasing. That's never happened in the 30-plus years that I've been in the industry. This is happening despite the fact that equity positions have returned almost towards the peak. The gray bar is cash out refinances. That's not the totality of a cash out refinance. That's only the cash back portion. So if you have a $200,000 loan amount and you're taking out $250,000, only the $50,000 is counted. In the green there are your home equity loans. So 10 years ago, yes, $745 billion as compared to $247 billion today, a massive $500 billion delta. So what's happening? CFPB, Dodd-Frank, new RESPA regulations have shifted lending. We now have to have appropriate licenses, federal licenses, and state licenses just for any one of our team members and associates to discuss a home loan with a consumer. We now house, and dare I say, not only one of the largest armies of licensed loan officers in the country, standing now at 1,700, collectively hold greater than 10,000 individual state licenses. But we also run practically a college campus doing state licensing on a regular basis. You can imagine what 11,000 state licenses and what that renewal feels like each and every year. So regulation certainly has played a significant role in the last 10 years. Capital markets, particularly in non-bank sector. Securitization, particularly on the MBS side, it's just much tougher. It's also much tougher, both in terms of equity and debt capital as compared to previous cycles. And of course, technology. The mortgage industry has not advanced for at least the last decade. It is just simply much easier today to get a non-mortgage loan where there has been some innovation in the last 10 years as compared to a home equity or a mortgage loan. So user experience plays a significant role also. These two boxes is interesting contrast. On the left there shows you the top 10 retail home loan lenders 3 years ago, 2013. Interesting to note that there were only two, if I can see that correctly, non-bank lenders being number 4 and number 8. And the top 10 held 31.7% market share. Fast forward to today, you now have 5 of the top 10 that are non-banks. And loanDepot came out of nowhere to grab the number 5 spot. What's interesting here, if you look at just this mortgage sector, you have quite a bit of change there. It's amazing how much it has changed in the top 10 in just 2 years, because there's only 14 and 15 is not shown here. But I think the opportunity for a company such as ours is not just the mortgage sector on this page. And that is what happens during this era and cycle. And as we move into modern lending, as we move into additional innovation that's picking up momentum, what happens to other financial services products? If you have the consumer's attention and you're creating intimacy with that customer, what other opportunities are out there? And I think that's the key with technology, particularly where we're at today, is I think you use technology to maintain your optionality and decide on a category leader exactly what coverage points you want your business to have going forward. I think largely is a bit unknown. Let's talk about capital markets a bit. Each bar is the actual volume of mortgage-backed security on an annual basis. A quick glance, you can see it seems to be fairly healthy or fairly stable over the last 5 years. But let's take a closer look. This now shows the portion of MBS that is non-agency, meaning non-Fannie, Freddie, FHA, and VA. This is the math that is staggering. Post-crisis, 96% of the MBS that's issued in the marketplace are agency product. What that means is there's hardly any non-agency product post-crisis that have returned to the marketplace. It's a matter of time before this percentage changes. Some of it is technology, some of it just the natural healing of the cycle, and certainly with all the noise about regulatory rollback or softening of regulation, we are predicting this percentage to change, and we certainly are positioning our company to be locked and loaded to participate in this return of additional product innovation through the market providing liquidity. Lots of capital being raised from the folks on this page. Really exciting. A lot of these companies are here today. These are all compartments, and the majority of them independent, non-bank lenders or marketers. Some stretches and utilizes its balance sheet, some do not, but they all have one thing in common, is they're trying very hard to figure out the liquidity to fund its assets. As this develops, it's interesting to note that 29% are focused on the left, and then 71%, which is the mortgage market, is being focused to the right. So one of the questions is, this type of monoline or compartment, is that sustainable? Are many of these companies going to remain independent? Will they prove out a profitable business model? Can they sustain the technology build, the marketing pressure, and the inconsistency of capital markets? Or will the compartments lead to market consolidation? I think we're already starting to feel a little bit of that. And looking ahead doesn't matter. I mentioned 71% is mortgages and home equity. Hopefully it'll grow right back to 75% or 76%. And then you have the other 29%. I think the lenders or the platforms that are able to pivot between this pie is going to have the ultimate competitive advantage. Not only does it give you the opportunity to create better user experience, but as the digital age becomes more mature, it becomes a product in your portal or on your web. And then ultimately, we all know, as a non-bank, one of the key costs to the model is cost of customer acquisition. So the cross-sell opportunity and increased conversion of having additional product mix is going to be one of the key differentiation points. Some early lessons. We launched personal loans about 2 years ago. If you look at it, it's really the same consumer. Again, it's shifting outside of mortgage lending into non-mortgage lending. A couple of lines there I'd like to point out. Number one is the interest rates. Look at that significant delta there. One is tax deductible, one is not. One is on a 15 to 30-year payback, and one is on a 3 to 5 year term. But if you look at the income, credit score, and age, very similar borrower profiles. This is where a cross-sell really becomes opportunistic for someone like us that has the scale and the marketing power. So with technology, regulation, and capital markets, where do we go from here? What's going to happen? You still have significant barrier to entry. It's much harder now to create any sort of startup. The cycle now is mature enough where you have known category leaders, companies that are following the category leaders are fighting hard, not only to prove out their business model, but it's much harder to raise equity and debt capital today. I think regulation is going to continue to be a key differentiator, particularly waiting and watching the new administration develop announcements and to be prepared and to ultimately leverage any new regulations. Non-banks, even if you have great technology and great marketing, if you don't have the funding to fund the assets, it's game over. I think a lot of our competitors are waking up to that right now. The best technology doesn't create funding. So non-banks must be very smart about following the money supply and understanding where we are in the cycle of capital markets and to manage that properly. And technology. It's definitely a love-hate. It's expensive. It doesn't create an immediate ROI. You've got to talk about investments. And you want a return on that investment. The way we look at technology outside of the standard, creating efficiency, creating a better user experience, for us, we really look at technologies of maintaining optionality. I don't think anyone, including myself, could be smart enough of a fortune teller to really see where financial services is going in the next decade or so. And we come back to some of the known modern brands and businesses. I constantly not only remind myself, but certainly our management team, Can we believe that when Netflix started, the business model was to mail out through snail mail a DVD? And if you're lucky, you get one that's not scratched, right? And then certainly, as the years went on, the business has changed. Today, it's amazing to see and to wonder if all of these products and business lines were in its original business plan. So as we move forward, where's loanDepot going? Well, we're going to continue to develop market share, being number 5 overall, including banks, and number 2, non-bank, with only 2% market share. We're going to continue to build market share. We're going to continue to utilize technology to build efficiencies. We're going to create better user experience. But what else? If it's a digital world and products become digital, how do you leverage that if you have that customer relationship? So this is why we continue to be disciplined over 2 fundamental areas of our company. Number 1 is protect the healthy core business. No matter what, you got to have a profitable, healthy, thriving core business. Nothing else matters. And number 2, invest into technology. It's a drip, drip, drip return. It's not a light switch. You can't come to work one day all of a sudden and say to yourself, wow, everything we've done in technology is really paying off today, finally. It's a residual over time. So tomorrow is exciting. Very, very early. And just like us moving forward, and I was here to talk about tomorrow, I think tomorrow's pretty unknown. And that's what's generating all the excitement for not only the industry, but certainly for loanDepot. So with that, thank you so much for your time this morning. I'm not sure if Peter wanted to conclude.
Yeah, we're out of time. Yeah.
We're out of time.
Yes.
What he's saying is I talk too much. Thank you very much, everybody.
Thanks, Anthony. Thank you. I'll take that. Yeah.